Okay, good morning, everybody, and welcome to the latest edition of the Hayes Family Advisors Client Update Calls. We have a very special guest for you this morning, Stephen Cheverone. Brandon and I had a chance to meet him at our symposium in person this spring with Stewart Partners. And Steve does a wonderful job of taking the complexities of the economy and the financial markets and distilling it into a story that makes sense. So we're honored to have you here this morning, Stephen. And just in terms of kind of firm updates, it's summertime. We hope you're enjoying it and getting in some fun amidst the raindrops. But as anything comes up that involves a dollar sign, of course, we're here. So please be in touch with any questions along the way. All right, Steve, I'm going to kick it over to you. Good morning.
Good morning. I'm excited to do this. I've got some updated slides that I'll show you today. This has been, I'll start with, how the year started. I think at the very start of the year, when we were asked how we thought 2023 could go, my response was we thought it could be a widowmaker, that it was a year that could really surprise investors, that came into the year very negative after last year. We thought that there was a chance that you'd have an upside surprise in the first half. And you could see some storm clouds either later in the year or even out in the 24. And I think so far, while we haven't gotten everything right, that's been more right than wrong. And so, what I'll do is I'll kind of walk you through what we see in the economy today, what some of the risks that are out there and how we're positioning against that. I'd start by saying, though, that at Federated Hermes, we have historically been one of the most bullish shops in Wall Street. It's a bias that is intentional. We're not bulls by mistake. Markets move higher over the long run. There's unlimited upside, and markets are positive 3/4 of all calendar years. They're only down 1/4 of the years, and they haven't fallen 100% yet. And if they do, we're going to have much bigger problems. But we were quite conservative, bearish last year, and I think that served us well. But as we got into this year, there were two views in the marketplace, both of which we were uncomfortable with. One of them was, the soft landing, immaculate disinflation argument that, inflation would come down, everything would be fine, there'd be no cost, there'd be no, bill to be paid. And that's really popular right now. History tells you that that's a low probability outcome. It's not impossible, but it's a low probability outcome, and we'll talk about why. On the other hand, there were a group of folks that expected an early, shallow recession, that there would be a recession very early in 2023, it'd be shallow, and then you'd have forgotten about it by the second half of the year. And we didn't think that things could deteriorate that quickly. And we thought, if anything, there is recession risk, but it's way further down the road, and that created an opportunity for rally. And so let's get into the slides. We'll talk about how we see things today. And hopefully you leave here feeling better about understanding how things are shaping up, assuming that we're right, which is a big assumption that you should never make. So, topics to discuss: inflation, Fed policy, labor market, economic data. Yes, politics. It's time to start thinking about 2024 and the election cycle and what that might mean. Unfortunately, I wish we didn't have to. And asset class views. Starting with inflation has peaked. That's the good news. And it looks like it's definitively peaked. Couple of considerations that I'd bring out. You peaked 3 times in the 70s. The 70s was not a single inflation event. It was 3 inflation events. And if you look, you almost came down to 2%, actually. And you were in the 2% in the early 70s. And the reason I bring that up is to say that if you don't fix the labor market or get it back into equilibrium, and then you start stimulating again, you run the risk of inflation reaccelerating. That's the upside inflation risk. On the other hand, this is also very interesting, you've never seen inflation fall this much without it being accompanied with a recession, which are the red bars. All right. While, and this is our inflation dashboard, don't worry about all the numbers on the screens. What I'm trying to point out here is that while the headline inflation number, when you account for food and energy, has come down, core readings have not. Core CPI is still running 4.7, 4.8. What's driving that? Services, service inflation is still over 6%. Wages is still 5.6% growth. And you don't need me to tell you that, just look at, look at what's going on at UPS, look at what's going on at United Auto Workers. I'm actively considering changing careers to a UPS driver after that labor deal. It seems like they're going to be just fine over at UPS. I saw a joke the other day. If you've ever watched one of these house hunter shows, particularly if they're in Canada, it'll be like, one person's a dog walker and the other person is a, full-time, flower smeller, and their budget for a house is $4 million. I think if you've got two UPS drivers in a family, you're going to be able to buy a heck of a house. So it's really this kind of core inflation. It is coming down, both the headline and the core, but it's grinding down. So if you look, right, the Fed has a 2% inflation target. They generally are talking about core inflation. At the pace that we're going over the last 3 months, at the end of this year, headline could get as low as 2.6, but the core reading is still likely to be 3.5 or higher. So not there yet is the story. Going in the right direction, not there yet. This is the labor market, and I want to spend a second here. This to me, I've said all along that there's no durable permanent peace until this chart gets fixed. So the blue line is the number of unemployed people minus the number of job openings. And the dotted blue line is the pre-pandemic average. So for 20 years, on average, there were 4.7 million more unemployed people in the economy than jobs available to fill. That's a normal set of circumstances in the United States. Today, there are 3.5 million more jobs available than people that can fill them. That's not normal. Because of that, wage inflation, so the amount at which your wage is growing, had averaged about 3.5%. It's now averaging 5.5%. Folks, you are not going to sustainably get to 2% inflation when workers are making 5.5% more. You give an American worker more money, we spend it. That's what we do. That's why this is the greatest economy in the world. And so you really need that blue line to go back to the dotted blue line and the red line to go back to the dotted red line. That means higher unemployment. Yes, some of that is job openings going away, but it likely means a softer labor market. If you don't do that, you run the risk of inflation resurging again. The Fed has gone hard. And so what you see here, these gray lines are a series of indicators. It's looking at employment, inflation, and financial conditions. And it says, well, what percentile rank or what percentage are they relative to their history? And then the black line is interest rates. So generally speaking, when those conditions are in their top half of historical outcomes, the Fed is hiking rates and the black line is going up. And when they're below that half, the Fed starts cutting. Well, this time around, the Fed allowed those conditions to be not in the top half of their historical outcomes, but the top 25% of their historical outcomes for a full year before they did anything. That is no bueno. And is a prime reason that we've had the inflation that we've had. Now, they've hiked rates aggressively, but those indicators are still in the top 25% of outcomes. And so rates need to stay higher for longer so that those indicators, the employment market, inflation, and financial conditions get somewhere closer to their long-term averages. And we're not there yet. Now, the question is, have they raised enough? And the answer is maybe. It's maybe. There's two schools of thought on this, that the Fed needs to raise interest rates above where inflation is in order to slow the economy. They've done that now. That they've done. So that one's a check. There's another school of thought that says, no, you've actually got to get above GDP growth plus inflation. And we're not quite there yet. And so that's the open question. Now, here's the bad news. The bad news is that historically, when the Fed hikes, recessions follow. So the Fed has had 9 hike cycles since 1970. 7 ended with a recession. 2 did not, 94, 95, and 1987. And soft landing predictions are common and generally wrong. There was soft landings predicted. In fact, the term was coined in 1973, right before the 1974 recession started, by a professor. I don't know where he was a professor at, but he should go back to class. One of my favorites here was from 2007, where Ben Bernanke was praised for steering the U.S. economy to an apparent soft landing amid a housing recession, and stepped out from his predecessor's long shadow and made decision-making more democratic, blah, 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 right before the largest recession we've ever seen in our life. So there's a natural human tendency to see soft landings. I'll explain to you why. That being said, what I'm going to build towards next is we don't think that recession is soon. And we think that there's upside bias to the market. Let me explain why. So the first one is the market expects that the Fed is on pause, meaning no rate hikes or cuts until May of next year. So if the last hike was in July, they don't expect the first hike really until somewhere between May and June. That would imply somewhere in the neighborhood of a 10 to 12-month pause. Interestingly enough, the average Fed pause after a rate hike cycle is about 9 months. So that's an average experience. What you will see, and there's a lot of numbers on this chart, on this page, but I'm going to spend a moment here because I think this is really important, is that what we've experienced over the last year and a half is perfectly normal. And if we continue on a perfectly normal path, we think that the market is likely to see new highs before any kind of problems arise. So let me walk you through it. During Fed rate hike cycles, markets on average are up about 7%. Assuming that we paused with the July 26th meeting, we were up 3.5%. So relatively average. Markets have big drawdowns during Fed hike cycles, somewhere in the neighborhood of 15 to 20%. Well, wouldn't you know, we had a 22% drawdown last year. A little bit higher than normal, but not outside the range. And then they rally. On average, the rally is 25%. Our rally was 27%. Interestingly enough, if you look at the prior examples, you had a big rally in 89, in 2000, in 2006, and 2018. All of those preceded recessions. So the first thing that you should put in your mind is that the market strength here doesn't tell you you are, and also doesn't tell you you're not going to have a recession. Those happened before each of the last 4 recessions. So just because the market's up means nothing. It just means that the market's up. In addition, you've seen the 10-year yield surge by 1.7%, probably a little bit more than that now. That's a little bit more than average, but not crazy. High yield bonds have remained behaved this time around, like they did every other time in the past. Unemployment, here's another thing you hear. Well, what's different this time is the labor market's tight and no one's losing their job. Okay. That's demonstrably false. In fact, unemployment fell in every rate hike cycle over the last 40 years. It's never risen while the Fed was hiking, not one time. So to expect it to rise this time was folly. The yield curve is inverted exactly the average amount it normally does. The one thing that's different this time, if you want to find something that's different, it's how dramatically inflation has fallen so soon. That historically, inflation doesn't respond to rate hikes until after the pause is completed, somewhere, 9, 12, 15 months after the last hike. So how do you explain the decline we've had so far? I think the decline in inflation that we've seen so far is not primarily about rate hikes. I think it's primarily about normalization post-COVID. That you've seen supply chain, and that's why you see it primarily in goods and not services, because supply chains have started to heal, companies have figured it out, that kind of stuff. When you get to a Fed pause, though, a Fed pause is a beautiful thing for the economy and markets, and has been basically every time. That markets return 14% while the Fed is on pause. They have rallies of 20% on average, 20 to 30% if you want to get more specific. Drawdowns, in other words, sell-offs are limited on average to 7%, which against a 20% rally is not all that significant. Bond yields do start to fall eventually. High yield bonds stay well behaved. The unemployment rate continues to fall. The yield curve stays inverted, but a little less so, and inflation stays stable. This is why the street always sees a soft landing, because they're worried that rate hikes are going to cause a recession. They don't. The market rallies at the end of the hike cycle because you've gotten through it, or you've gotten towards the end of it and the world hasn't ended. Then they stop. So the rate hikes are no longer a threat. The Fed's not hiking anymore. And unemployment isn't rising yet, and credit's behaving, so soft landing. It's Wile E. Coyote running over the cliff, historically, is generally what happens there. But that's beautiful for equities, and it can last for a long time. So here's the cautionary tale and why you need to be cognizant of this. I want to go back to June 29th, 2006. So in June 29th, 2006, you were sitting ahead of the biggest recession in our lifetime, right? The 2008, 2009 great financial crisis. The Fed had been hiking for 2 years. The market had just completed a 25% rally, and unemployment was down 1% from when they started hiking. Everything was great. Now, let's say you were the big short guy, and you thought to yourself, well, that's all fine and dandy, but I know a recession's coming, and Fed pauses are preludes to Fed cuts, and so I'm going to sell now. You were wrong for 15 months. That's a year and a quarter. You missed a 26% rally, over which time unemployment didn't rise at all. If you're in my business, you were unemployed on the day that you were finally right. That's the problem. Now, here's another cautionary tale. There are examples of soft landings, and 95, 96 is one of them, where the Fed did start cutting and you didn't get a recession. How could that happen this time? How could that happen this time? It could happen if inflation comes down fast enough, the Fed is able to cut before people have to refinance their debt, right? So the big ticking time bomb for companies is that the reason that they haven't gotten hit by higher rates is because they all went out pre-pandemic and took out 7-8 year loans at 0% interest or some very low percentage rate. And so until they have to refinance, they're not in trouble. And so if the Fed can get the inflation down and back off of the rate hikes before they have to refinance, you could get a soft landing. That's the upside scenario. And it's not a zero probability. So because of that view around Fed pauses and economic data that's been better than expected, we've increased our forecasts this year. Our GDP forecast has gone up. Our earnings forecast has gone up. Our price targets have gone up. Our equity weights have gone up. Our view on bonds has improved, and our underweight to credit, and we're still underweight credit, has come down a little bit. And it's because of this chart. So what this chart looks at is how economic data is coming in relative to expectations. When it's red, it's disappointing. When it's green, it's doing better. And you can see it's doing quite a bit better. And you have to respond to that. Doesn't mean recession risk isn't there. It just means it's not today. We're watching a number of variables, and I won't go through all of these. And what we're looking at is, if you look at this chart right now, it's mixed, tilting towards green, right? If you're headed towards a recession, we expect it's going to become more tilted towards red. So what are things we feel better about? We feel better that inflation's coming down, the stock market's doing well, credit's doing fine, the housing market's rebounding, services are doing a little bit better, income growth, so this is wage growth minus inflation, has finally turned positive again. Consumer confidence is okay, oil prices are firm, which is good before a recession. Earnings estimates are holding in. Money supply is shrinking, and that's a problem, but it's a little bit better than it was. Unemployment's kind of holding in. But what we're worried about is manufacturing is contracting significantly. The yield curve is inverted. The market's expensive. Bankruptcies are starting to pick up. Retail sales are starting to slow. Leading indicators have turned negative. A lot of people are bullish right now, and defaults are starting to pick up. So you can see it's a kind of mixed picture. You got to be open-minded to both sides. All right, let's go through some of the positives, some of the negatives, and we'll kind of wrap it up. We have what's called a recession dashboard. It's 6 indicators that we think have historically been predictive of recession. And the story remains the same. It doesn't look great. It's not all green, but it's not looking at a recession just yet. And if you look at how these indicators have acted over time, going from their best level to a start of a recession, it would indicate that there's really not a ton of recession risk until the second half of next year. Again, that's very different from what the market had been expecting. And because of that, that's why the market's rallied. Credit conditions are tight, but they're stable. Here's another thing, and this comes into this idea of not yet. What you see here are delinquency rates on different kinds of loans. So take a look at the blue line. I know there's a lot of colors on the page, but take a look at the blue line, which is credit card delinquencies. They've started to rise sharply from roughly 4% of credit cards being 30-day delinquent to something like 6.5%. That's a big increase. But if I draw this line back, it's still lower than at any place it's been over the last 20 years. So it's going in the wrong direction, but it's still benign. In order for these delinquencies to become a real problem for the economy, they need to continue to rise. One, there's no guarantee that they will. And two, that takes time. It just takes time, and we're not there yet. In addition, the United States has a couple of big tailwinds. The first one is unlike Japan, China, and Europe, we don't have a demographic death spiral. We're not losing 20 to 35% of our workforce over the next 20 years. It's going to grow. And because of that, and because of some of the disruptions during the pandemic, we're seeing people rethink their supply chains. The day of producing in China for cheap labor isn't there anymore. The labor is not as cheap, and you don't want to be there because shipping costs are higher and energy costs are higher, and there's no intellectual property protection, and there's geopolitical risks everywhere, and there's no transparency, and CEOs are disappearing. And if you believe there were only 200,000 cases of COVID in China in 2020, then I've got a wet lab to sell you in Wuhan, right? I mean, all of those things. And so foreign direct investment is plummeting in China. And where is it going? It's going to the United States. The center of the United States is the next great emerging market. We've got more land than we can fill with people, so much energy that when we drill for oil and natural gas comes out of the ground, we set it on fire. Easy shipping routes to the east and west coasts, at least when trains aren't derailing. Ironclad IP protection, one of the lowest tax rates in the world that hasn't changed under a different administration, and wonderful bourbon, but no new diseases out of Kentucky. And what you see is that the number of jobs that are coming back to the United States are surging, and the contribution to GDP growth, to the economic growth that's coming from constructing manufacturing in the United States is at the highest level it's been since 1981. Those are big positive themes. In addition, it looks like the worst of the earnings cycle has just passed us. So it looks like earnings are going to have fallen about, S&P 500 profits will have fallen by about 4.73% in the quarter that's currently being reported. But if you start to look out the next couple of quarters, expectations are that we're going to return to growth. And because of that, we have an above consensus earnings forecast, for this year. Now, these are some of the things that are worrying us. The yield curve is inverted. Yield curves being inverted aren't what you worry about. It's when they uninvert that you worry. That usually comes along with the Fed cutting rates. Again, we think that's not until the second half of next year. The entire yield curve is trading below the federal funds rate. I don't need to go into it too much other than to say that's historically been a very reliable recession signal out into the future. Money growth, the amount of money in the system has shrunk. It's the first time it's shrunk since the 1920s. I don't really know what to do with that, but my guess is it's not all that positive. Leading economic indicators are as negative as they've been prior to any, recession in the past. But again, there's a lag on that. We're watching small businesses. Small businesses have seen it, that they're not very optimistic. Their earnings have been falling. They're slowing their hiring plans, and they expect that credit's going to be harder to come by because small businesses lend from small banks. Small banks, banks below 50 billion provide 60% of all small business loans. Banks below 250 billion provide 80% of all small business loans. So if small banks, these regional banks, come under some pressure and they just got downgraded by Fitch, that's going to impact lending to small business. And that matters because small businesses employ 46% of workers in the United States. The consumer is also something to watch. I'm going to start with this chart on the bottom left. This blue shaded area is the amount of excess savings that consumers have amassed. So if you think about consumers save a kind of average amount, and that's this dotted line, during the pandemic, we spent a significant amount of time above that dotted line. And consumers saved 2.6 billion extra dollars, 2.4 billion extra dollars. So savings accounts were pretty fat. Since then, inflation has eroded a big chunk of that. And so that 2.4 trillion of extra savings today is only 126 billion of extra savings. It will probably be gone by the time kids go back to school. And so we no longer have that extra savings buffer. And credit card usage has surged. So in the last 24 months, 2 years, credit card balances are up $260 billion. That's the biggest increase ever, almost ×2. That's a big increase. Now, this is the chart to watch, though. Real income growth, the amount of money you're making extra in your paycheck minus inflation, was negative for 2 years and was causing this erosion and was causing people to use credit cards. It just turned positive again. So again, this element of time, does this turn positive enough before these become a problem? I don't know the answer to that. I don't know the answer to that, but that's something that you need to watch. Default rates in companies are rising. Weaker companies, particularly in areas like broadcasting, healthcare, industrials, retail, technology, are starting to see a big increase in defaults, meaning companies that aren't paying their loans on time. At the pace we are this year, if we end the year at this, if we continue at this pace for the rest of the year, this will be the third worst year for corporate defaults in the last 30. And it'll only be surpassed by 2020 and 2009. So again, something to watch. The government is insane. And I'm not saying anything that anybody here doesn't know. And I know that this is recorded, and I stand by that comment. We're running deficits right now that are comparable to the deficits that we ran during the pandemic without a pandemic. And what I'm about to say is not a political statement. It's purely a mathematical statement. This is not a tax problem. It is, in fact, a spending problem. And here's why I say that. This chart goes back to 1960, but I could run this chart back to 1760. And what you will find is that the federal government has never, ever, under any circumstances, with any tax regime, ever been able to raise taxes that are greater than 20% of GDP. At 20% of GDP, something happens. Either the economy slows meaningfully and tax revenues fall, or the incentive to cheat becomes so high that people cheat. My guess is it's a combination of both. I don't know why this is the case, but even at 100% top marginal tax rates, we still never got above 20% of GDP in terms of tax revenue at the federal level. Folks, we are damn near at 20%. On the highest GDP the country has ever seen. Put more simply, the federal government has never collected more money from taxes than they are right now. And there's not even a close second period. The problem is that historically, we run our spending also right at 20% of GDP. So we average about 17% tax revenues. We run the spending at 20. There's a 3% per year deficit. Right now, we're running at 25.5. So even though we're bringing in the most money we've ever made, outside of the depths of the pandemic, we're spending more than we've ever spent. Why does this matter? It hasn't at all until now. Debt as a percentage of GDP in 1980, 1990, let's say 1990, was a third of where it is today. So our debt was 50% of our national income. Today, it's closer to 150% of our national income. But it's been okay because the interest that we pay on that debt fell from 3.5% to 1%, 1.25%, because every dollar of debt that was issued here was a 10% bond. Well, when that rolls off and you replace it with a 1.5% bond, it works. We've all experienced this in our lifetime. Think about if you or your parent had a mortgage in the 80s versus today. You could afford a lot less mortgage then than you could now because rates were so much higher. That doesn't apply right now, but for most of the last 20 years. Same thing with the federal government. The problem is now you're rolling off 1.5% debt and you're replacing it with 5% debt, 4.5%, 5% debt. And so you've started to see interest expense rise dramatically to the highest level in 20 years. And unless something changes very dramatically very soon, you're going to see interest expense surpass the 1990 peak. Again, that's not good. Now you're getting into that 3.5%, 4% and remember, when you think about the federal budget, most of it is, Social Security, Medicare, all of that. So, at this level, at 2%, 3%, 4%, you're already exceeding the military budget, to put that into perspective. This is causing something to happen with the 10-year yield potentially. So there's something weird going on with bonds right now. Bond yields should have fallen this year, right? That was the conventional wisdom, that inflation was slowing, the economy was slowing, and the Fed was going to no longer, finally get to a pause in hikes. And traditionally, that means that bond yields fall and bonds rally. And it ain't happening. What you're seeing is that bond yields are rallying and bond prices are falling, and we're back up close to where we were at the peak in bond yields. Well, when we were at 4.25% in September, inflation was 9%, and the Fed was hiking rates 0.75% per meeting. Now inflation's 3%. They might be done with the hikes, but we're back at 4.25%. This is why. Because in order to fund this deficit of 7-8%, the federal government has to issue debt. They've got to issue bonds. Well, the Fed isn't buying them anymore because there's no more QE. And Japan is buying less because they're I don't want to get too technical, but they're moving away from yield curve controls, which means they have to buy fewer treasuries. And Russia's buying fewer of them because we confiscated all their wealth from them. And the Chinese are buying fewer of them because they don't want us to confiscate their wealth. And so you're seeing the 10-year yield move up, and it's something to watch. I don't know what it means yet, but it's something to watch. I'm going to skip this. I'm going to go into politics a little bit. Before I go into the politics, I'm going to say that I really don't care about how you feel about politics. I don't care if you're on the left. I don't care if you're on the right. I don't care if you like what I have to say. I don't care if you don't. That's entirely a you problem. My approach to it is this. If you go to Wall Street, actual Wall Street, and you go up the street, what you'll find is that on the left side of the street is the New York Stock Exchange, and on the right side of the street is Federal Hall, the country's first capital. So politics and markets have been facing off against each other since the very beginning of the Republic. And if you go to the end of the street, there's Trinity Church, which is where Alexander Hamilton is buried. And I like to joke that on the left side of that church are the careers of all those folks who couldn't buy the market when Donald Trump became president. And on the right side is the graveyard of all the careers of folks who couldn't buy the market when, I don't know, Barack Obama became president. And I don't want to live in either one of those graveyards. So I'm looking at this purely through the perspective of what's it going to do to the markets. If you want to know my personal opinions, then you absolutely need to buy me a bourbon. But getting into that, there are 0 recessions over the last 100 years in the third year of a presidential cycle. The elevated opportunities for recession generally come in year 4 and year 1. There's a reason for this. First year recessions being the most common is presidents like to do things that are painful as far away from an election as possible. So I get elected, I do all the unpopular stuff, and then the economy starts to gain steam in year 2. It's doing real well in year 3, right as I announce re-election odds, and then I get elected. Likewise, if there's trouble on the horizon, I like to do everything I can to delay it so that it hits before people realize that everything's going to go bad when they vote for me. There's a reason for this. But as you look into the next 2 years, 24 and 25, historically, based on the presidential cycle, those are a little bit more at risk than this year. The math looks pretty good in the Senate for the Republicans to take over. So what you see on this chart is, I think there might be what you see on this chart is the blue line is Biden's margin of victory in different kind of Senate states. And the green is the senator's margin of victory. So Biden got destroyed in West Virginia, Manchin severely outperformed. Same with Tester in Montana. So when you look at this map, what you see is, one, Democrats are defending a lot more seats in the Senate than the Republicans are this cycle, almost twice as many. Most of those are pretty safe. It's popular senators in Biden territory. But you also have some senators that last time around outperformed Biden in territories that aren't very blue. And this is where Senate control is going to be controlled. And there's 2, Republican seats that might be vulnerable to the Republicans, Rick Scott in Florida and Ted Cruz in Texas. And then there's some Democratic seats that are at risk. Joe Manchin in West Virginia is particularly at risk because as popular as he is in West Virginia, the governor of West Virginia is going to run against him, and he's even more popular. John Tester in Montana, Kyrsten Sinema in Arizona, Sherrod Brown in Ohio, which, Ohio has become really more of a red state. Tommy Baldwin in Wisconsin, Robert Casey in Pennsylvania, Jackie Rose in Nevada, and Debbie, I don't know how to pronounce her last name, in Michigan. Those are the seats that we think will control the Senate in 24. You can kind of go through these, when you look at how the map looks today, it looks like the Manchin seat is the most likely to flip sides at this point. That would get you at least to 50 Republican seats in the Senate. And then, you've got the 3 toss-ups. Tester, Sinema, and Brown would be the most likely to go. So we're going to watch those closely. Trump looks like he's on the road to the nomination at this point. And you can like that or not like that. But I mean, he's leading, in the Iowa caucus poll by 24%, and the New Hampshire primary by 22%, and Nevada by 32%, and South Carolina by 19%. This is his polling numbers. He's above 50% in the average of polls from RCP. But look at the fundraising numbers, and DeSantis is doing very strong in the Q2 fundraising numbers. You'll also see, if you were to look at Trump's polling support at this point in 2015, he was down in here. So frontrunners don't always do well in primaries. It's one of the reasons why I think he's loath to debate, because he stands to lose more on that debate stage than he does gain from it. I also wouldn't count out Vivek, who's, starting to gain the kind of fundraising numbers that's putting him in a real conversation here, and is at least going to get him on that stage. So it looks like it's Trump, but, don't count out DeSantis just yet. The presidential map will likely come down to, the same states it did last time, right? I mean, it's Wisconsin and Pennsylvania and New Hampshire and Nevada and Georgia and Arizona. From a Republican perspective, based on the polling today, Trump makes it close, but falls short again. DeSantis has a pretty convincing victory. So, and what complicates this further is a lot of Trump's trials start in May. And this is where you got to be careful in this political cycle. If Trump amasses a ton of delegates early, and then is somehow convicted in a way that precludes him from being able to have the nomination, you won't have a nominee that is elected. You would have to go to an open convention and have the old guys in the dark room with the cigars pick a nominee. My guess is that will not be positively received by a large group of folks in this country. That will be viewed as at least an interference in the democratic process. So something to watch as we get into the middle of next year. Again, you start to see the middle of next year gets kind of complicated. You could have this issue, the recession dashboard kind of points there. You might start getting into rate cuts. That next part of that second half of next year is a time to really kind of take a look at things. We do an election dashboard, a re-election dashboard, where we look at a series of indicators that have historically been predictive of whether or not a president's going to get elected. It's been pretty perfect, actually, over the last several years. So what are the things that we're looking at? Are incomes growing? If they're growing well, the president has a higher chance of getting elected. Is unemployment going up or down? If it's going down, you got a better chance of getting elected. Is the stock market up or down? Pretty self-explanatory. Are consumers confident? Do you have a recession in the third or fourth year? And are you popular? Generally speaking, if more than half of those are pointing in your direction, you win. If less than half of those are pointing in your direction, you lose. Trump, because he's Trump, had to go in at exactly half. So it was a toss-up and you didn't know how it was going to go. As things stand today, and again, for the prior cycles, you're looking at these right on the eve of election. For today, I'm looking at it as if the election was today. So it might be, it might tell you nothing. But as it stands today, 5 out of the 6 indicators are pointing in the direction of the president. So as unpopular as he is, and let me tell you, he is historically unpopular. I mean, he's 4 percentage points less popular than Donald Trump was on the eve of the 2020 election. He's only a 0.5% more popular than Jimmy Carter was before he got, unseated. But if you look at this, incomes are up strong. Unemployment has not risen. The S&P 500 has been strong over the last 3 months. Consumer confidence is high. And, unless something materializes, the consensus isn't seeing a recession this year or next. If those hold true on election day, he's got a real chance of being reelected. That's what this tells you for now. All right. Finally, we'll get to the asset classes and I'll wrap this up because you should only have to listen to someone drone on for so long. The market has been dominated by big tech, Magnificent Seven, Big Eight, whatever you want to call it. On a year-to-date basis, this is through June 30th, the market was up 16%, but it was up 16% because these 8 names were up 60 and the rest of the market was up 3. We expect that that's going to broaden out. Large cap growth and the NASDAQ historically do best during hike cycles. When you get into Fed pauses and you get into Fed cuts, large cap value starts to do better, small cap value starts to do better, the Dow Jones starts to do better. And we've started to see some of that. If you looked at this at the end of May, the entire market was 0 and these were up 50. You're starting to see, we think, a broadening out of the market rally. And so we're overweight everything that's not large cap growth. We're overweight large cap value. We're overweight small cap value. We're overweight small cap growth. We're overweight international development. Large cap growth and the big tech names, in our view, are just way too expensive. And let me explain to you what my thought is on there. We came into last year trading at a 30 times multiple. So that means we were paying $30 in stock price for every $1 in company profits. We've only done that twice, the dot-com bubble and the pandemic. And the reason we did it in the pandemic was, 1, interest rates were 0. So you pay more for longer term stocks when interest rates are 0. And 2, I was locked in my home in the People's Republic of New Jersey for 2 years. And it got so bad that I even watched an episode of Bridgerton, which is the worst thing I've ever seen in my entire life. And I never want to watch it again. And the reason I bring that up is all I could do was watch Netflix and Google things and buy stuff through Amazon and look at my Apple phone. I had to use tech goods. It was all that was available to me. So to trade at that expensive of a rate made sense. I no longer am under house arrest. I can leave my home, I can go to dinner, I travel, I drink bourbon, I go to baseball games, right? I don't do that. I can do more. And interest rates are no longer zero. And so then the question becomes, well, what's a fair price for growth stocks? And in the 5 years prior to the pandemic, you traded at somewhere between $16 and $23 for every dollar of profit. We got back there late last year and the beginning of this year. We got right to 19 and a half. If I could go back and do anything over, I would have bought more tech at that time. I was chicken to do it. But since we've gone back up to $26 per dollar of profit. And again, if I draw that line, it's also true that I only did that during the dot-com bubble in the pandemic. Here's the cautionary tale. In the pandemic, you ran up to 35. You came back down to 20. You went back up to 26, 27. If you bought that rebound in large cap growth stocks, you didn't make your money back for 20 years. That's not a good risk reward. Instead, I like this better. So this dark line at the top is large cap growth, the big growth companies. The gray line are small cap growth companies. They started selling off almost a full year before the large caps. So they had a 2-year decline, not a 1-year decline. They bottomed roughly 3 months earlier. And they're still down 20% from when they started. They're still down 20% from where they started, where the growth stocks, despite how painful their decline was, are 20% above where they started 2 years ago. In addition, they're not as expensive on a PE basis. There's a little bit more growth there. They're more cyclical. You tend to see a broadening out in a small cap growth as you get towards a Fed pause, and IPO activity is picking up, which can really boost returns in this space. So we like small cap growth. In addition, we like the dividend payers, which have underperformed massively this year. I'll call your attention to the chart on the right. Generally speaking, for 20 years, dividend stocks would trade 1 or 2 PE multiples below the market. So if you were paying $16 for $1 of profit for the S&P, you might pay $14 for $1 of profit for a large, safe dividend stock. We're trading $8 less per dollar of profit. That's about as cheap. That's as cheap as it's been at any time in its history, other than right at the bottom when we were really under house arrest. That's attractive to me, particularly if some of those storm clouds that we talk about start to materialize next year. I'm going to go out less, and I'm going to go on fewer vacations and all that, but I'm still going to eat, and I'm still going to heat my home, and I'm still going to take medicine, and I'm still going to buy my medical devices. And so we think there's a relative defensiveness to these names. We think their balance sheets are strong, and we think they're dirt cheap, and nobody likes them right now. And I generally am in the business, although it's hard of doing it, of buying low and selling high. And I think I'm selling growth high, and I think I'm buying dividend stocks cheap, and it's painful to do it right now, and everybody thinks we're wrong, and that makes me more certain that we're right. I'll just skip on the bond side. We like longer term bonds, and we like safer bonds. We think that as the economy slows, there's going to be some credit stress, and we don't want to take on that stress. I want to leave you with one final note, because there's a lot of cross currents. You hear me talk about being quite bullish in the near term, seeing new all-time highs on the S&P. We think you can see the S&P at 5,000 before this is all said and done. We think we've got a runway of somewhere in at least a 9 to 12 month, environment where the economy and markets are quite good. We think the jury's out on whether or not you can achieve that soft landing or a recession, with odds probably more on the recession side, but not certain. A lot of cross currents, right? And we didn't even get into all the nonsense going on in China or Russia or Ukraine. So what I want you to keep in mind, though, is this is an example of 2 hypothetical investors, both of which put $100,000 into the S&P 500 on New Year's Eve, 1929. Not exactly the best time to buy the market. One of them forgot that they did it. They put all the stock certificates under floorboard. And 90 years later, when they died, their kids found it and collected the winnings. The other person was an incurable optimist that was too dumb to know all the reasons why they shouldn't buy stocks. And they bought $1,000 a month, every month for 90 years. And they were so dumb that they bought during the Great Depression, during the World War, they bought during a Korean War, they bought during Woodstock, they bought during inflation and Tricky Dick twice, and I don't know, Jimmy Carter's sweaters, and George Bush puking on the guy from China, and Bill Clinton and his dresses, the Red Sox winning the World Series, every matter of calamity that you could imagine, right? They bought $1,000 a month. How did the two do? The person who did nothing did pretty well. They earned a 13,000% return over 90 years, which comes out to about 5.5% a year. The person who was too dumb to know all the reasons why they shouldn't buy stocks didn't get 13,000%. They got 92,000%. They generated an almost 8% year return, beating the market by 250 basis points per year. That's like Warren Buffett numbers, right? 250 basis points a year for 90 years. How does that happen? It happens because they bought the same dollar amount every month. And when they did that, when the market was cheap, they bought a lot of shares. And when the market was expensive, that $1,000 only bought a few shares. Congratulations, you have now timed the market perfectly with no chance of getting it wrong. So there's always a debt ceiling, and there's always a downgrade, and there's always a recession to come, and there's always something that's overvalued, and there's always a Ukraine, there's always all of those things. If you have the means in the stomach, you invest through it. If you're older in your life and you need the money sooner, I would also point out that the optimists outperformed not just over the 90 years, but in the 1930s, 40s, 50s, 60s, 70s, 80s, 90s, and 2010s. 8 out of the 10 decades. Pretty good. Pretty good. So, yes, there are parts of the market that we find more attractive than others. There are some storm clouds that we might see that might come to fruition, sure. But the long-term story is you want to stay invested and you want to buy through it because it's worked forever and it works for a reason. So with that, I will stop. I know I went a little bit longer than I wanted to, but a lot to talk about today. Happy to take questions if there are any. Otherwise, I can let you good people go about your Wednesday. Thanks,
Steve. I really appreciate all your thoughts and love the note that you end on, because when we have our clients positioned in equities, it's for the long term. And it's nice to see how it's borne out over the past 100 years.
Prices go up as long as you have babies and make new things. We still have babies. And when we don't have enough, we import babies. That's called immigration. And no one makes more new things than we are. We know this. And we know it's not the Chinese because no one in the history of a Ferrari ever stole, I don't know, a Chevy Cavalier, right? If you have the Ferrari, you don't steal it. So if they had the technology, they wouldn't steal ours. We have it. And so I wouldn't bet against either of those things.
Well, I love that too. We typically ask our clients to follow up if they have questions for you that we'll pass on to you. So we appreciate that. Thank you, everybody, for your time today. I really appreciate you being on the call. And have a great rest of your summer, everybody. Thank you.
Take care, everyone.